So we have 25 minutes, but maybe a couple of days worth of conversations we could have today. So I'm going to dive right in. Private credit has seen exponential growth. Just last year, we saw about $1.5 trillion in assets, crossed $1.5 trillion in assets, but it's projected to be about $3.5 trillion in assets in just 3 to 5 years. Set the scene for me here. We haven't seen it quite take off in the global south, and especially in our markets. What's it looking like? And maybe I'll start over there with you, Omar.
Thank you very much. Good afternoon, everyone. The global south historically has exported most of the capital that we have from a sovereign wealth perspective, and a lot of our family groups have done that to diversify away from their core economies and core geographies. What has happened so differently now, and what we call it the renaissance of our Middle East 2.0 since the discovery of oil, is the realization that Vision 2030 in Saudi, Vision 2040 in UAE, requires that the middle class actually grows in a significant way. And to do that, you need alternative financing to do that, because generally the banks, who are asset-backed lenders, lending to the largest institutions, largest family-held institutions, as well as government entities, are not playing in the space. So how does the middle class grow? It's alternative credit. For private credit, humbly speaking, at Ru'ya Partners, we target mid-market lending to corporates primarily in GCC, Saudi, and UAE. And why that is, the funding gap that exists is over $250 billion. It's a funding gap that existed for a long time. So to your point, why haven't we seen this before? Because there wasn't a real, true visionary plan to actually change the middle class dynamics, which now there is, with real backing from sovereigns that backed us and backed a couple of our peers. So things are changing. Things are changing in a very positive way. And it's not just about nice buildings. It's actually about evolving landscape and financial world that we have in the ecosystem.
David and Shirish, Omar works more in the mid-market space, but what are you seeing at your end of things with the larger deals? What are you seeing in terms of how it's taking off here?
So just to put a little bit of context around what drives private credit, one's obviously the demand side of things, and there are plenty of opportunities in the entire global south, including the MENA region. The issue that we've got is there's a lot of capital sloshing around waiting to be put to work, but there are a few sector-specific or geographic-specific structural points that are holding this back. Now, I'm not saying they're going to hold this back forever. They're going to be addressed over time, but structural change in any economy takes time. I mean, one of the key things you need is basically a very strong local presence, if not boots on the ground, at least a very significant amount of time for that investor to come in, understand the market, understand the structure, understand the legal ramifications of a downside planning, et cetera. And that's not easy for a lot of global capital investors to do. Secondly, this is credit. I mean, I guess Omar is referring more to growth capital, where we focus most of our time on is traditional direct lending, where it's an operating business, it's got some issues as far as the funding gap's concerned, and it's not a venture-type debt investment. And for that, downside protection becomes really, really important. So a lot of it is asset-based lending. But it will change, but there need to be some structural factors that's going to drive that change. So I see a lot of opportunity going forward, but I think it's going to take time. But David, perhaps your views on the other end of the spectrum?
Yeah, and I think to paint the picture a bit more, the 1.5 trillion or even more of private credit in the world, 2/3 of that nearly is in the US.
Right.
About 24% on top of that is in Europe.
Yeah.
Right? So when we talk about the global south, we're talking about a tiny percentage. Asia is about 4%.
And look at how big the global south is.
Exactly.
So.
And when I look at the numbers for Middle East, some of the numbers I've seen is 0.2% of the overall private credit space globally. Now, clearly, there's a huge amount of growth that we can expect to come from that. As the economies sophisticate, as we've seen the economies sophisticate so rapidly, particularly in the UAE and Saudi recently, with new legislation, new regulators, new ecosystem with professionals, it's rapidly sophisticating. So therefore, the next step as part of, in our world, to join that sophistication, you need that alternative credit opportunity. In order for, you've got two sides of that coin, right? Where's the supply and where's the demand? We saw a very similar dynamic in India. We do a lot of our private credit funds are in India, or in Asia, and part of that is in India. We saw a similar dynamic before their new bankruptcy law came in 2016. There was very little onshore international lending because the risk was seen to be too much. If you went through a restructuring, it would take 20 years, 25 years. So the risk-adjusted returns just didn't make sense. We see a very similar dynamic here over the last few years, but now there's new bankruptcy laws and so on.
Yeah.
Over the last 5 years, the Indian market, the AUM of the alternative credit space has grown from 5 billion to 25 billion. Wow. Arguably,
just off of the legislative changes.
because you put in place an environment and the legislation, and as those precedents start coming through,
Yeah.
the international investors, other investors start getting comfortable with investing. They start seeing real returns. They see the bankruptcy laws working, restructuring working, getting real dollars out the back. So you can rely on your security. You realize that when you have collateral, secured collateral, you can actually enforce as a downside protection.
Yeah.
So that increases your demand, and at the same time, the regulator put a lot of pressure on the banks to start dealing with their problems.
Yeah,
So we started, you had the demand and the supply working at the same time, and all of a sudden the market started growing. You start setting the precedents, you start then attracting more foreign investment. And we see that this region is at the very start of that process.
Yeah.
we
And
can
our
s-
laws have just come in quite recently and are beginning to be tested.
Exactly.
Talk to me about how the returns differ across perhaps the more evolved markets, the majority in the US, compared to maybe what we can expect to see here. What's making it attractive for us here? And I'll move back to Omar because I see him smiling as he's thinking
Sure.
about it.
What's quite surprising and pleasantly surprising, that is, for a lot of LPs that we've spoken to internationally who've had, as well as regionally, who've had exposure to large credit managers, is the fact that we, humbly speaking, in a very emerging market, Middle East, growing, where we're able to give senior secured loans, getting MEZ-like returns. So generating 15 to 18% without using any leverage. And that's a huge significant differentiator.
Without leverage?
Zero leverage. I mean, the banks don't give us leverage anyway, so even if we want to use it, it hasn't evolved to that space. But we actually, it's just based on the credit itself. The credit of companies that are growing, that are going through huge transformation, whether it's Saudi companies growing more in Saudi, or UAE companies growing into Saudi or in UAE. So these are growth capital needs, pure on the actual merits of the loans themselves, we're able to generate these returns. And in terms of the security package that you get, whether it's full suite of covenants, which is unmatched in the West is a sponsor-led market. So while the good news of the sponsor-led market is that you have abundance of deal flow activity from a lot of M&A, the Middle East still does not have that. So what we're talking about is looking at a $2.5 billion worth of transactions each year, just bilaterally through us talking to advisors and business owners in UAE and Saudi particularly, to fill that funding gap that exists. So when managers look at us from outside in, they think, well, what is the alpha? That's the alpha. To get these type of returns in the West, they use a lot of leverage to get those type of returns for senior secured. If you go down the spectrum and maybe go to special sits, you can get that without leverage, but that's kind of where the alpha for us is.
Shirish and David, I see you nodding because we were talking about this just as we were coming. Would you agree with those numbers
Yes, I would
and
agree.
compare?
I would absolutely agree with what Omar said because, look, drawing parallels from different parts of the world, a private credit situation either in the US or Europe always has an advisor, they always have a process, they always have effectively an auction. So what's going to win out is not the quality of your capital, it's price. But in the global south, that doesn't exist. So if you're prepared, as I said earlier, to spend the time and effort to get proprietary deals, your returns are not going to be bid away because it's not an auction process. If you're a first mover or you have a unique angle, you're going to get that deal and it's not going to be shopped. So that's another thing that kind of allows those returns, those unlevered returns, to be driven because they're not going to take a proposal from Omar and then shop it to 15 other funds. That doesn't exist, that dynamic. And it may change over time, but today that's one of the advantages of those, or one of the drivers of those returns.
So speaking of demand, paint me a picture of the kind of demand that we can see, because it's just getting started. David, you talked about the numbers. We're so tiny in comparison to the rest of the world. So what kind of demand are you expecting to see, and what sectors are attracting the most interest from private
In
credit?
the Middle East?
Yeah, in the Middle
Yeah,
East, and also if you want to maybe go slightly wider than that.
Sure. So in the Middle East, we're seeing opportunities just falling in our lap, which, you know, until we raise the right kind of capital for a private credit fund that's dedicated to the region, it'll be a challenge to deploy too much. At the moment, just to put it into context...
It's a good problem to have.
Well, we'd rather have the capital to deploy. But we run about 3.4 billion in total. We run a secondary fund, which is about 600 million, that is open-ended, that we can invest in secondary credit, and that's where most people in the Middle East know us from, because we invest in secondary bank loans, claims, high-yield bonds, and so on throughout Asia, Middle East, and Europe. So we've deployed in this region, in that market, since 2011. So we've been part of this credit story, and particularly in the stress-to-stress space, for that time. What we do in Asia, we also run closed-ended private credit funds, where we typically lend to mid-market corporates on a senior secured basis. And just from a return perspective, we achieve sort of mid-teen net returns for senior secured risk, which you can't find in the US, right, unless you lever it. Here, the type of opportunities we're seeing is very, obviously we're moving in slightly different circles to Omar. The opportunities we're seeing is on the special sit space, where you've got typically private corporates in the industrial or real estate sectors that are not finding traditional bank finance and do not have the alternative. There is no dedicated capital in this space for that type of...
Is it just mostly real estate and infrastructure where you're seeing the demand, or what sectors?
In different geographies, it's different. So in the UAE, it's a very real estate-driven opportunity set. And what we're seeing is that banks are reaching their limits lending to the government borrowers, and you're leaving private developers that have a great opportunity set, great growth market, with a gap in financing. So there's an opportunity there, and we're seeing some of our peers providing some finance in that space.
And next door in Saudi, I guess it's a much bigger...
In Saudi, the opportunity set that we're seeing is very different. It's very much on the industrial side, where we're talking to CEOs and advisors of large corporates that are suppliers to the giga projects.
Right. So because the banks are lending to the giga projects.
Well, the opportunity is they've got a huge order backlog. There's a huge high growth environment for their product. They may have had issues over the past cycle where the banks have or have not solved the debt structure through a restructuring. But in any case, the banks are not providing that working capital line. So there's liquidity need to grow into this high growth environment. This is exactly the type of lending we do in Asia, where we can solve their liquidity issue on a senior secured basis because we're more flexible in structure, because we can get to know that mid-market company, we can really understand their product. And once you solve that liquidity issue and they grow into that opportunity set, then the banks come back, right? And they want to get rid of us because we're expensive. Right?
Shirish, you were talking to me earlier about also the size of deals on these. Tell me a little bit more about that opportunity, because yes, there's opportunities falling into everyone's laps, but what's the numbers on there?
See, on my business, it's somewhere between what David does and what Omar does, but sort of closer to David's point, where it's slightly stressy. Now, most direct lending deals in this region have been in the $10 to $20 million range, equivalent. Now, that is very, very small compared to Europe or the US, but then again, the market's different. When Europe and the US were nascent, you could still do $25 million direct lending deals, and then as the product became more accepted, they grew in size. So the opportunity for anyone trying to invest in this region is to pick those businesses which require 20 million today, but with the strength of the business model and the growth embodied in it, they're going to want 200, 300, 400 million in 3 to 5 years' time.
Like we said, customer loyalty.
That's the sweet spot. But to add to something that David said, rather than looking at things by industry or by type of business, some of the things that we're seeing is, for example, Asia, be it Korea, be it India, be it the Middle East, there are lots of family businesses and they're family conglomerates, and now we're in the third and the fourth generation from the founders. So over time, they've built a collection of 20, 25, 30 businesses. A lot of them are related, a lot of them are unrelated. And now there's a third and fourth generation that wants to start businesses that are unrelated to the historical family business.
Right.
And traditional sources of finance are more than happy to finance the traditional business that they know for 30 years, but not the grandson's pet project that has real potential,
And I guess
but doesn't
that's
fit
where
within, and that's where I think
Omar comes in.
Omar might come in.
Omar, talk to me also about the numbers here in terms of, is it sort of, are we talking $10, $20 million range, or what sort of solutions are you seeing for mid-market that perhaps you could compare to traditional lending?
Sure, thank you. So typically we do anything from $10 million to $30 million. Historically, when my partners and I, many moons ago, started the first fund at our predecessor shop, the average deal size was about 15. If you're lucky, you get $20 million deal, and everybody's high-fiving each other for $100 million deal flow annually. Today, because of the evolution of the market and how things have progressed, the average deal size is 25, 30, and now it's very common that we're seeing 50, 60, $100 million deal. Last year, or was it earlier this year, we lost to a San Francisco partner-based private credit firm who invested $90 million in Property Finder. Great deal that we liked, we looked at, but $90 million was too large for our current fund size.
Yeah.
So the good news is the opportunity set is larger than ever. The deal flow is there. They're all senior secured, at least the ones we're looking at. And international managers are looking at this space in a very different lens. To give you an example, our old shop, the alternatives team who we're all friends and part of, got acquired recently this year by Janus Henderson. Now, most of the folks, at least in the Middle East perspective, never really knew Janus Henderson very well. And, well, what did they find so differently? They're not doing this as a token investment. They're seeing this from a risk-reward perspective. There's a real opportunity set, which we've been, obviously biasedly saying there is a real demand here. And to add to that, the regional allocators, the likes of Mubadala Capital and a bunch of sovereigns from Saudi, have backed us because they're also seeing the reality on the ground that don't just give us money because this is a token investment and we're based in ADGM. Give us on the merits of the credit that we're actually providing and the returns that we're generating for our investors. And that's the lens they're looking at us now, which is very different.
So it wouldn't be fair for us to just talk about opportunities, though. These are new and also emerging markets. So what's the largest risk you're seeing in our markets? Because they are still relatively new to this space, and also we're quite unique in how we do things here. I want to be mindful of the time, so if each one of you could list one.
One thing, I think the reality when people ask how many enforcements you've had to actually go through, and their answer is 0, it gives people a surprise discomfort. They say, well, this hasn't been tested yet, right? It will come. At some point, we will have to use an enforcement scenario, go through an enforcement, and when it does, we'll deal with it with the proper regulations like in ADGM. So the challenge is it's a new market, so
it's not tested yet.
It's not tested yet. Even though we're using English law from a jurisdiction perspective, it hasn't been tested yet.
Well, special situations carry even more heightened risk. What's your biggest concern?
See, whether it's a special situation or growth lending, the concerns are the same. So if I were to list my top 2, the first one would have been what Omar's already mentioned. But the second one would be, look, you have to get comfortable making investment decisions with less than perfect information. You cannot look at this with a US lens or a European lens where you've got all sorts of information, it's organized, there's a process, etc. The secret sauce here is you've got to be able to use a lot more judgment based on the information you have rather than working from a perfect example of what a US or European investment committee would need. And if you can get there, that's where you can generate the proprietary opportunities. But David, your thoughts?
Yeah, by the way, I wouldn't call special sits higher risk.
Really?
I think that's a misperception because people see that
The
in
larger,
special situations. The point is pricing that risk. Right? So if you're buying in the secondary market in a distressed situation, you're pricing at a price that creates the value at a level that limits your downside. Right?
Yeah.
If we're lending on a special sits perspective, we're putting in a dip financial.
Would you say it's less risky then?
I would argue so.
Okay.
But it obviously
We
depends.
can have that face-off
But
later.
it depends on the price you pay, right?
Yeah. It depends on how
How
good
you
you are at
structure it,
pricing
yeah,
that risk.
yeah.
On the special situation side, when we are lending to a company, say a bridge loan or a dip finance or a dip-like financing, where you're priming or getting senior security over assets above the other lenders, that arguably is much more a safer investment than coming in at the same
Right.
at the same pro rata level, right? So that was just a point on that. But the key point to all of this is understanding your geography. If you fly into this region and expect to do a private credit deal with a family
No.
and have no risk, you're barking up the wrong tree. So Omar, like ourselves, we've been operating in this market for a very long time. We understand the ecosystem. We understand where the risks are, and it's about pricing those risks,
I
right?
guess also what the theme that I've been hearing a lot is the days of fly in and out are gone. You've got to be based here. As we only have a couple of minutes left, let's talk about the future. So with all this pain will come opportunity. In the next 5 years, where do you see the biggest opportunity? And a side question to that, we've just heard about, sort of seen the deal recently with Mubadala and Blue Owl Capital. That was around $1 billion. Are you going to see more sovereign wealth funds kind of go down that route? And we'll start over there with you, Omar.
I'm biased, but I think the best days are ahead of us here in the Middle East, and it's not just about real estate and fancy hotels, it's about the real emergence of the middle class with the help of, humbly speaking, ourselves and a few others that really help finance great businesses with great founders that simply haven't had the same financing options that the Western peers in both Europe and particularly US have had for decades. So I think the next 5 years, you're going to see an emergence of not just a senior direct lending strategy, but a real estate, an infrastructure, you name it, across the spectrum, whatever the areas of the world has, we'll be able to replicate here in the Middle East.
Yeah.
I'm going to be very quick. I completely agree with Omar. Nothing more to add.
What are you eyeing, though, as you know, the most interesting opportunity for yourself?
Look, at least as far as private capital is concerned, you have to go with the size of the economy. So the UAE and the KSA are going to be the two biggest sources of focus. But look, you can't necessarily ignore all of the other GCC nations. You can't ignore Egypt. You can't ignore Jordan. So the focus here is to at least keep tabs on pretty much all of the major economies here. But I think just given their size, the UAE and the KSA will probably lead.
Yeah. David, your opportunities falling in your lap, but the next 5 years,
I think so.
what's interesting?
Honestly, I think so. The direction of travel in this region is very, very clear, right? Over the last number of years, everything has sophisticated at a hugely... I mean, look where we are. The ADGM this is the third year of these conferences, and what they've achieved in a very short space of time is miraculous. So you can see the sophistication, you can see the will of the powers that be to create a sophisticated economy. And so therefore, if you simply overlay what we see in other geographies that are sophisticated economies, alternative credit, private credit is a large part of that. So it's very clear the direction of travel. This is going to grow at a huge rate over the next 5 to 10 years, no doubt.
I'm afraid that's all the time we have, but our panelists will be around, hopefully, to take questions later on. Thank you very much. Can we have a round of applause for all the great insights?
Thank you.
Thank you.